Welcome to the Investing Show and a special episode on consumer protection. As consumers, are we being treated fairly by the financial industry? Are we receiving value for money? And are regulators doing enough to protect our interests? I'll be speaking to three people who think there are serious causes for concern. Coming up, Alan and Gina Miller from the True and Fair campaign will be telling me fees and charges are still far too high and large financial businesses are resisting the changes we need them to make. But first we'll hear from Andy Agathangelou, chairman of the Transparency Task Force. He's concerned that the Financial Conduct Authority has a new responsibility to help improve growth and increase the UK's international competitiveness. This, he says, creates a conflict of interest which could be detrimental to consumers. Andy, the UK financial regulator is the Financial Conduct Authority. What are its duties and responsibilities?
One of the key considerations, Robin, when people are investing is to place their money where they feel it'll be safe and hope that it's going to perform well. Once upon a time, the UK financial sector did not have the benefit of a well-regulated and well-run financial services sector. These days, of course, there's a pretty extensive regulatory framework, and the conduct aspects of that regulatory framework fall into the remit of the Financial Conduct Authority. They've got several jobs. Perhaps the most important as far as this conversation is concerned is creating a safe market where people can have confidence that things will work as they should.
Relatively recently, under the last Conservative government, they were actually given a new responsibility. Tell me about that.
The new responsibility is an interesting one. It's all about growth and competitiveness. What the government essentially are looking for the Financial Conduct Authority to do is to not just regulate the market, but also to try to create the right kind of conditions such that the UK financial services sector operates well internationally, that it's competitive, that it attracts business into the United Kingdom. That in and of itself is obviously a very laudable objective. There is a bit of tension though, Robin, between whether the priorities ought to be about protecting consumer interests and looking after investor interests, or becoming, if you like, a cheerleader for the city. And that's a very, very difficult balancing act. And depending on where people are on that spectrum, they might think it's too far one way or too far the other.
Reading what the FCA has said about this new responsibility, its view appears to be that it is perfectly consistent to want to improve consumer protection and to grow the economy and the financial industry as well, because those two things go hand in hand. There's some truth in that, isn't there, surely?
I think there is a degree of truth in that. The word consistent in this context is quite interesting because the Financial Conduct Authority has not always been keen on it having a growth and competitiveness objective. For example, only a few years ago, the former chief executive of the FCA, Andrew Bailey, put himself on record speaking against the idea of a competitiveness and growth objective. He spoke about the inherent conflicts of interest between, on one hand, protecting consumer interests, and on the other hand, becoming a spokesperson or a cheerleader for the city. So it does seem as though the FCA itself as an organisation's position has changed over the last few years. The good news here is that it is a secondary objective. So what the FCA would say if you were to ask them, I'm sure, is that yes, we do understand that there could be circumstances where there's a bit of a playoff between consumer protection and promoting competitiveness and growth. But if such an issue arose, the competitiveness and growth objective would always be secondary. We won't compromise one for the sake of another. And again, depending on whether somebody's cynical or not, they might think, well, that sounds fine. Or they might think, you know what, we've actually built an unnecessary conflict into the system by having that approach. And everyone's going to have their own point of view about that.
This is a direction of travel that the last government embarked on, but the current Labour administration is also in favour of it. Do you think this is coming from politicians, or is it coming from lobbyists? Is it coming from the financial services industry?
That's a remarkably interesting question, Robin. If we look at this from an international point of view, there's quite a bit of research suggesting that a country's primary sector has huge power over its government. For example, in Australia, the mining industry is massively important, and as an unsurprising consequence of that, anything to do with mining and exploring for new metals, etc., is very subservient to the lobbying powers of the mining industry. In the UK, financial services is about 8.2-ish% of gross domestic product. Historically, of course, financial services has been a flagship industry for our sector, our economy as a whole. So it's not surprising that we do have phenomenally powerful lobbying capabilities in the City of London. My hunch is that the pressure, if that's the right word, to create the kind of conditions to stimulate growth and competitiveness probably came from the city, not members of parliament representing their constituents. This takes the conversation to a really interesting place, and that's the playoff between growth and risk. Allow me to elaborate, if I may, Robin. We all remember the global financial crisis. Not only did it cause a significant amount of economic carnage around the world, it also caused a massive amount of human suffering. Some would argue that the repealing of the Glass-Steagall Act was a contributory factor in that. They would argue that the deregulatory agenda that took place in the US allowed the circumstances that enabled the banks to do the crazy things that some of the banks then went on to do. So there is a tension between trying to achieve lots of growth quite quickly and doing so in a semi-reckless way. I personally think what this means for retail investors is to be prudent, to be cautious, to work with professionals that they have some confidence and trust in, and to take on board as much data as possible from numerous places to try to make well-informed, balanced decisions. And if they do that right, they've got as good a chance as any of having good returns over the medium to long term.
You mentioned trust there, which is obviously very, very important in relation to financial services. And the FCA has tried to improve trust by introducing what's called the consumer duty, and that came into force in the summer of 2023. We've now had more than 12 months of that. In your view, how's that gone?
The consumer duty, to be frank with you, Robin, is a topic I'm thinking of quite a bit at the moment, not just myself. One of my colleagues at the Transparency Task Force, Mark Bishop, who's one of the members of our advisory group, has been spending a significant amount of time really getting to understand what has been happening around the consumer duty. What's particularly interesting is that we think consumers would actually be better off if they had a duty of care. The two phrases sound remarkably similar, but they're actually very different. A consumer duty is effectively a set of requirements that the FCA have created that the financial services sector must abide by. But in the event that a company or an organisation doesn't follow by the rules, the individual that may be harmed as a consequence doesn't really have much power themselves to do much about it. A duty of care, on the other hand, does carry some real weight. And there was a bit of a fork in the road, if I can put it that way, a few years ago. The Financial Services Act 2021, passed by Parliament, actually required the Financial Conduct Authority to explore the idea of introducing a duty of care, this powerful, legally robust instrument that would have provided what's called a private right of action. Unfortunately, and again, depending on how cynical somebody might be, whether that was by accident or by design, the Financial Conduct Authority actually failed to carry out the wishes of Parliament and it introduced a consumer duty, a watered down version. So personally, I think what the industry's now got is several hundred pages of pretty technical regulatory gumph to work through that does have the general intent of looking after consumers' interests, but would have been far cleaner and far simpler had they gone down the other fork in the road, the duty of care, which is what Parliament wanted them to do.
Why is this private right of action so important, do you think?
Well, of course, we live in a parliamentary democracy, and our elected representatives create laws for us, and the purpose of those laws is to protect everybody, to give everybody the same level playing field. What a private right of action does is it gives the individual consumer the ability to sue a company if that company does something that would have led to foreseeable harm. It actually puts the control in the consumer's hands as to whether to take action or not. What we don't therefore have, if we don't have a private right of action, is we don't have the retail investor in the driving seat, so to speak. We have the regulator in the driving seat. That's all well and good if you have complete trust and confidence in the regulator's ability to look after consumers' interests. And you know what? Let's return to that theme. Depending on where you are on that spectrum of cynicism, you might think the FCA, of course, does have the interests of consumers at heart. At the other end of the scale, you might think it's rather conflicted, and as a consequence, won't always act in the consumer interest.
The FCA has put out a call for input into the consumer duty and how the first 12 months of consumer duty have gone. What will you, as an organisation, be saying in your response?
We really welcome the chance to have our voice heard. It's great to have the opportunity to respond to such a consultation. Our response would probably be led by Mark Bishop. He'll be the lead writer of it. And its key messages will be, FCA, you definitely took the wrong turn. You definitely should have gone in the direction of duty of care, not consumer duty. That'll be one very, very important piece. We'll probably talk about how and why they ended up going down the wrong route. The second thing we'll probably say is that the general direction of travel is good. Having a consumer duty is better than nothing at all. So real progress is being made, but there's enormous scope to improve the situation, Robin, there really is. And of course, at the end of the day, the stakeholder group that matter most is the consumer, the investor. Are we providing them with the best possible information and the most protective regulatory framework to protect their interests? If we are, then we're doing all we possibly can to encourage good investment into good products through good organisations. If we're not, then there's still work to do.
Andy, there is a massive pension savings gap in this country. You know, people are not investing enough for their long-term financial security. What would you say to people who say, you know, Andy makes some interesting points, but actually he's scaring people into, you know, not trusting financial professionals and not investing in the first place?
I really hope I wouldn't be scaring anybody in that way. We have a very simple rule, which is to do everything and to say everything from an evidence-based perspective. Being evidence-based, Robin, I know is something you can very strongly relate to.
Absolutely.
And if the evidence says that in the past there have been folk who haven't been trustworthy, then that's what the evidence says. If the evidence says that people need to be cautious and prudent, then that's what the evidence says. You know what? In my personal opinion, the value of a trustworthy financial advisor or a trustworthy financial services firm is off the scale. Wonderful. My message to any retail investor is keep looking until you find an organisation you feel comfortable with, that you think is actually providing the kind of products and services that have you, the client, at the very centre. And when you think you've found those kind of folks and those kind of organisations, be loyal to them, keep working with them, and keep supporting them as best as you can.
I'm really pleased to hear you say that. I absolutely agree. One final question. What would be your message to regulators, you know, people at the FCA, about what they should do, and also to politicians? And of course, we've got a new team of politicians in power now. Well, what would be your message to them?
My message, I guess, if they were ever to want to listen to somebody like me, would be to think about things from an international perspective. There's so much best practice going on in the world of regulation of financial services around the world. For example, in Australia right now, they've carried out a forensic analysis of the main conduct regulator called ASIC. They found that it's come up pretty short when it comes to standards of driving good behaviour into the market. And there's so much in the recent report about ASIC that I would encourage the FCA to read and ask yourself those kind of introspective questions. Are we potentially capable of improving the way that ASIC in Australia is? And if they conclude that, yes, you know what, there's a lot of scope for improvement, then get on with it. Make it happen. The FCA's got so much power. We often think it doesn't make good use of the powers that it's got, but it's capable of achieving the kind of transformation it needs to achieve if it decides that it wants to do it.
That was Andy Agathangelou from the Transparency Task Force. So what did the FCA have to say about some of the key points he raised?
A spokesperson for the regulator said the Consumer Duty sets a higher standard of consumer protection in financial services, which plays an important role in promoting effective competition and innovation and supports UK growth. We are not going to delete the FCA handbook. We have published a call for input to explore how we can simplify the requirements on firms dealing with retail customers and to ensure our regulation remains effective, streamlined and comprehensible.
Now, you're probably familiar with Gina Miller from her legal challenges to Brexit. But she and her husband Alan are also long-standing campaigners for greater fairness and transparency in the financial industry. Their True and Fair campaign has been critical of the industry and the way it's regulated for many years. What do they make of the state of financial regulation today? Alan and Gina, there seems to be this confusion now about what the Financial Conduct Authority is actually for. Do you think there's a conflict between this move to encourage economic growth and increase competitiveness and also this underlying responsibility to protect consumers?
I agree. It can definitely be a conflict of interest. I think it really seemed to have stemmed from maybe the Treasury and the Treasury Select Committee a few years ago, where in a way the gradual diminution of the UK stock market against its peers worldwide, and it was thought wrongly, in my view, that somehow by reducing regulations on companies listing in the UK, that was the answer that would encourage more companies to list here. And they seem to have completely forgotten, actually, it'd be better to maintain high standards and encourage more money by, for example, having different rules on how pension funds can invest to retain their tax status, and other means of doing it. Instead of which you have this kind of basic conflict that, reducing the protection, particularly for UK listings, is obviously hugely potentially detrimental to investors, be they individual investors or institutional investors. And whilst you can say rightly that to be more competitive, that might imply less bureaucracy, less regulation, less unnecessary paperwork and form filling, that doesn't seem to be where it's heading. I mean, that would be a positive, that you kind of protect the consumer and you also encourage the industry to be more effective by helping the industry work with the consumer for better outcomes. So you make it easier in terms of giving suggestions on how to do X or Y or Z, or the definitions of things like what is exactly a vulnerable client, and work with the industry on protecting vulnerable clients that way, rather than this continued kind of just increasing regulatory burden, which then has a danger it then doesn't actually protect the consumer and it doesn't help the industry.
So, Gina, the FCA says that it wants to help encourage firms, financial businesses, to locate to the UK. As Alan says, what's good for the industry is often bad for consumers and vice versa. There's a tension here, isn't there?
What we need to do is to have a financial services regulator that is fit for purpose and is protecting consumers and sticking to its 12 principles of business and treating customer fairly. All the things that the FCA is doing, it should be doing. The problem is that at the moment, the lobbying from the industry, and not just financial services from retail end, but from private equity and hedge funds, seems to be cozying up to government. And I think that's what's very worrying, is that supposedly in this push for economic growth, we could be seeing that they're pushing for reduction in regulations that don't necessarily benefit consumers, but also that the government is stepping back from actually making the FCA more robust. Because actually there is a separation. The Treasury and the government promoting the economy is not the same as the FCA promoting the economy. That is not the role of the FCA, in my view. It was set up to, protect consumers and to promote better outcomes and, things like the consumer duty that we will go on to talk about. But there is definitely a conflict brewing, I think.
So, consumer duty. That is an example, Alan, surely, of the Financial Conduct Authority actually getting its act together and genuinely helping to protect consumers.
Yes, I mean, we can see, for example, with some very major companies in the UK, which would say the name, but it's self-evident that without the consumer duty, they wouldn't have, first of all, reduced the number of funds, secondly, reduced the fees quite materially, and thirdly, some of the practices which everybody's known about for a very long period of time are gradually ceasing. Now, you can say, actually, there was this principle before of treating customers fairly. So it seems kind of, in a way, bizarre that treating customers unfairly for many years wasn't against treating customers fairly, but it's now against the consumer duty. But, if it produces the end result, that's good.
It's a good direction of travel, but isn't it the same thing just being called something different? Because I go back to what I mentioned just now, the 12 principles of the FCA of how a business should operate in the financial services sector are very good principles, but I would argue that they've not been adhered to and they haven't been enforced. So now bringing in consumer duty, the focus at the moment is on vulnerable clients. But vulnerability is episodic. So, just what is the duty now on firms to check in somebody's vulnerability? Does that mean you have to regularly do it? Because it depends on what stage or what's happening in their lives. Are they going through a mental health crisis, divorce? It's not something that's constant. So it's unclear to me how you measure that vulnerability on an ongoing scale. And then I hear that the future, what they're going to go on to now and talk about is fair value. Now, it is right, we should be operating under fair value anyway. That comes from fees, transparency, products. So yes, we should have that. But shouldn't we have had that anyway? I mean, it does seem to me that they are coming up with, the sentiment is right, absolutely. But the burden on the industry could be such that it puts businesses out, we have an advice gap, we have an investment gap, we have a savings gap. To put more burden, administrative burden on firms without supplying templates or explaining to firms. I mean, I don't think they're rushing ahead with this, but the burden could be actually the unintended consequences of it, of doing it in the way they're doing it, could be that a lot of firms actually can't afford to up their compliance or increase their regulatory burden. And how do they do it at the same time of lowering their fees or being more competitive? There is a conflict there.
There's an issue, isn't there, Alan, that the larger firms can afford to respond to these demands or requirements from the FCA, but actually, the one-man band financial advice firm, for example, who's doing a very good job serving his or her clients, it's expensive and it's very time-consuming.
Yeah, I mean, obviously that's why they've become parts of networks to try and have access to those resources, but it's still, a certain amount of compliance and fulfilling is in everybody's interest. But the problem is, whether it's the advisor or the fund manager, is when it kind of goes beyond that, and is counterproductive, because it actually can lead to worse consumer outcomes, because A, you might not make the right decision because it doesn't fit the box, or secondly, there isn't the time to do the most important things because you're form-filling.
If I give you an example, I mean, we can, at our business, we can because we're on platforms and we've got AI, we can actually program it. So, for example, one of the things we have to measure, my understanding ongoing, is the quality of our communications and our website, everything that clients experience. So that means we're going to have to check in regularly with them. Are they understanding what we're sending out? Is it in a way that's comprehensive to them? We have to keep confidence. One of the things they're talking about is not just vulnerability, but it's confidence. Do people feel confident? This word keeps being used, and yet we already have identified that, say, under 35s and over 65 for women have a problem with levels of confidence and also higher levels of vulnerability. So, the extra work of having to filter out those clients you may have on your books or potential clients and have a different level of contact and communication with them is something we should be doing as businesses anyway. And I think most good businesses are already doing that. But the fact it has to be formulaic now and done in a proactive way, because most clients will come to you and say they're going through a divorce or their partner's died, if it's a joint account or whatever, and then you deal with them in an appropriate manner. But for you to proactively have to go out there and check that, I mean, how often are we going to have to check that? Do we have to check that every quarter, every 6 months, annually? We don't know.
I mean, I don't know if you know about the during COVID, they had a COVID survey which all the firms had to fill out. Now, when COVID finished, the COVID survey carried on, but when somebody pointed this out, it changed its name to the Financial Resilience Survey, I think it is, and most of the numbers are provided in returns, which most firms do every single quarter anyway. So, I mean, I think it would be good if there was a department within the FCA that looked at the regulatory burden and concentrated on things that are most important and did it in the most efficient way and gave, help to firms to say, actually, we can't tell you exactly what to do, but here are documents, formats, particularly for your example or individual advisors, then they would know that was compliant. They have to follow the information instead of never knowing beforehand. And obviously the winner is the compliance advisor and the compliance firm.
But one of the big failings is, as a regulator, they're there to assist the industry and to assist us, and they are very bad at doing that. And that's why I think if you bring in new regulations and new rules and new what you're expecting firms to do, then you should help them with that. And they're not very good at doing that.
I think that we should give the FCA credit for a number of things. Consumer duty was an example. Yeah. Another one, and you, Gina, you mentioned value for money. I mean, the assessment of value regime, for example, is a positive thing generally. It requires asset managers to actually review the value for money that they're providing for clients on an annual basis to prove that they're providing that value and take remedial action if necessary. That's positive, isn't it?
Yeah, I mean, at the beginning, there was a lot of kind of gaming the system, yes. And some of the reports, it should have been kind of being the fiction section of the bookshop, where you had funds who had disastrous performance, and somehow they were good value for money because they had a nice brochure and a nice report, and. But it has got better, and you can see, there's been more kind of funds being closed, merged away, fee reductions. So that has been positive, but that's required, if you like, the FCA rightly to intervene when at the beginning firms were, quite a large number of firms and large firms were gaming the system. And so they have to kind of not just put in the rules, but enforce the rules. And the same probably applies, with consumer duty, where again, I won't mention large firms, but, the whole industry has had kind of issues with one or two large firms where they say, well, we follow these rules and the large firms doesn't. And going back to your competitiveness, that makes it very hard because as a small firm follows the rules and the large firm basically finds ways around the rules, then it doesn't enhance competition and it is wholly unfair.
So we've had these massive outflows from active funds and into passive funds and passive ETFs. You know, in a sense, the kind of future that you guys and I were predicting 10 years ago, it is, surprise, surprise, it's actually happening now. But still, there are some very large active fund managers who are stubbornly holding out with their relatively high charges, certainly very high in relation to passive funds. Firms like Aberdeen, for example, and Schroders. There seems to me to be an obvious solution for those firms. To be more competitive, they've got to lower their fees. Why don't they lower their fees?
Well, I think it kind of they have a very hard financial kind of equation and issue is that if the right thing to do is to lower the fees, but if they lower the fees, is that going to compensate the extra business? Going to compensate for that? And there's a high degree of inertia in financial services investing. And as you say, even if they reduce the fees, there will still be much lower charges by the passive funds or other active funds around the corner. So in a way, I would describe a lot of these big firms as the equivalent of an insurance company in runoff. They're just gradually going down as more and more clients realize actually they're getting a very bad deal. And it's virtually impossible when you get to that size of those companies to outperform anyway. So, and the diseconomies of actual skill within fund managers, you're bound to kind of get the committee think the bigger the company is. It just has to happen outside, Warren Buffett and his small team. There is that negative kind of correlation, and therefore I'm sure I heard a policy saying actually, we can't, if Schroders, let's say, has an average fee of I don't know what it is, but let's say it's 0.3 and it moves it to 0.15, does that double the size of the business? Probably not. So it has a 50% in that example reduction in revenues.
So rather than promoting it, I think it's they're relying on the client as you said, inertia. But carrying on earning while they can, and client behavior changing rather than their behavior changing. So they'll make hay for as long as they can. I mean, there is no, the equation is too difficult, especially when you have such large overheads for these businesses.
So, Alan, as you say, we are increasingly seeing smaller firms being taken over by large consolidators.
And in the IFA space.
In the IFA space. Very often these large consolidators have their own platforms, they've got their own investment propositions, their own ways of kind of making money out of clients, if I can put it that way. Very often they're taking over firms and putting clients into more expensive products.
I would have thought it is an area which actually the FSA should focus on, and particularly as some of those consolidators financially, have large amounts of debt. So, I mean, go back to financial resilience. I'm not sure how much financial resilience there is to many of those consolidators, and also the centralized proposition, whether that's actually in that individual consumer's best interest. So I think there's a lot of questions actually on those consolidators and the prices they're paying, and we've already seen there's a big legal spat or whatever between two of those companies on its managed portfolio service, and one suing the other. I don't know who's right or who's wrong, but it shows there's big issues and big potential conflicts there.
Gina, if we could ask about Britain's largest advice chain, St James's Place, and they are now rolling out an offering of not low cost but lower cost passive funds and broadly passive funds. It's really encouraging, surely, to see a firm like SJP acknowledging that it has to change its ways.
I think absolutely, because of the brand awareness that they have and the market share that they have. I think it's really important that the big firms, when we started in 2009, we said the worst thing of all would be if we were still the lone wolf shouting in the wilderness, that we had to look at lower fees, much more transparency, better consumer outcomes, and more investment in passives, and not just sitting in passive funds, but actively passive, and ETFs, all those trends we want to see in the market. So it is encouraging. What I think is not encouraging is we're still not seeing the advice gap shrink. And for me in particularly, I'm very concerned about is we're not seeing an increase in investments when it comes from women and a younger audience. So we've still got the problem, we're shifting a couple of percent, it's growing the market. We still have a problem in the UK about getting enough people to think about investing and saving in their futures. So yes, it's the right direction, but we also, that lowering of fees, better outcomes, better products also needs to be accompanied with more education and more awareness. And I think that's where we're falling down at the moment, is that as an industry and government, we're not doing enough to build confidence and educate people about the need for investing and looking after their financial health and their financial futures. So, as an industry and a regulator and the government, I think there's a lot more work to do there. But when it comes to lowering fees, I think I don't understand, going back to SJP at the moment, when we had RDR and the whole rule change there, I still don't understand how they got away with that, because there seems to have been much too close a relationship between them and government. But because they seem to get away, but now they haven't, and it is right that all fees could be transparent. But again, on the transparency of fees and lowering fees and being more transparent, we still don't have a mandated formula or format of how it's to be displayed. Again, there's still more work to do to make sure that it is completely understood by a prospective client or by clients, exactly what they're paying and what they're paying for.
Anna, just moving back to regulation, you have been very outspoken in the past about the Neil Woodford scandal, if I could call it that. Of course, we've had finally some developments, haven't we, on that front in the last few months.
When you consider not the FCA figures, but how much investors actually lost, which is well over £1 billion. Now, whether you would say that they lost it because the prices of the underlying securities fell or whatever, the fact is they lost more than £1 billion. The fact is the Treasury mandated a report into it. The fact is that report was not going to cover whatever role, whether it's positive or not, of the FCA into that breakdown, and there was no report. So consumers who have lost £1 billion, and they still are out of pocket, because even after the compensation, which, good on the FCA to forcing that large payout for Link, but it's not the whole £1 billion. It may be part of the amount which was associated with Link, but the losses were far greater than that. And even if it was 100%, which it isn't, why not actually have the inquiry and learn lessons from it? And kind of everybody's in the clear, isn't it? So why does it just not happen again? Because the lesson is you can take £1 billion off investors, and your downside is some bad articles.
So Gina, we see all these initiatives and papers and consultations from the FCA, and here we had an absolutely massive event which was very much in the kind of public eye, and yet it took so long to deal with from the FCA's point of view. We haven't had a proper inquiry. Why not? And have we really learned the lessons from what happened there?
One of the things we do need to think about really significantly as an industry and for the FCA is around whistleblowing. Because actually there were people who were already, we actually sent the FCA report and accounts from the what was happening at Woodford, and we couldn't be a whistleblower because we were a competitor. I believe that was so. We are not classed as a whistleblower, even though we have the knowledge. And so there's certain things that need to be looked at, but quite often they're the people that need to be looked into. And the recent debacle around whistleblowers at the FCA is not good. We rely on whistleblowers to actually come forward to ensure the consumers are protected in many instances, in many scandals. And so that has to be an area that we focus on and promote.
Yeah, I mean, on the Woodford thing, we're not saying that he took the money, obviously, and he had various investments which went wrong. The fact is it stems from this mismatch of the liquidity and the risk to what people expected. And it was all there in the report and accounts. So given the regulator regulates, and given it was one of the fastest growing and largest funds, and it was in there black and white in the table on the back of the report accounts from year one every single year, but absolutely nothing happened. And that's why they presumably don't want to investigate it.
How likely is it, that we see another Woodford?
Maybe you see less on the basis that you always need a third party, like, Link in that instance. And those third parties, which maybe, not saying individual companies, maybe kind of didn't do the full due diligence or protection, given the fines which have happened in the Woodford, are less likely to allow that. And so in a way, maybe they'll actually do the job of the FCA by stopping these things in the future more than they have in the past.
Guys, this has been fascinating. Just to draw this discussion to a close, to focus on investors, what would you say to them? I mean, you have been warning investors for many years that they were overpaying for largely poor performance. As we discussed, thankfully fees to a degree have come down. There seems to be much more awareness of the importance of fees and the failure of active fund management and so on. But how careful do you think investors still need to be today?
I think it's still very difficult to find the fees and we still have some work to do to make sure the clients or prospective clients understand risk, reward, and fees. It's about promotion and education. I still think there's an awful lot of work to do as an industry about that, and getting people to realize that they need to start earlier and younger, because it's painting us in the picture of the fact that the public purse is not going to be there to fund your retirement or your life goals. So we are a very vital industry. So there is still that message that we need to get out there and make sure that when they do invest, that actually we are, as an industry, regulating ourselves. Because, going back to the original question and some of the discussions we've had about consumer duties and things, if the industry itself, if we had already behaved better and put our house in order collectively as an industry, the regulation wouldn't need to have come down so heavily on us and all these now new duties and compliance. And so what I would say to the industry is, yes, we have to educate and encourage more people to invest, but also we have to be the ones to act first, to be good businesses, to ensure that there isn't an increase in this regulatory burden or the compliance burden that we have to that is going to crush us if we're not careful.
The Woodford scandal, for example, and a few others we've had over the years, they're very bad news for those good small financial advice firms who are looking after their clients very well. And the danger is that this is going to put people off trusting in financial professionals. How important do you think it is that we rebuild that trust, and what kind of value do you feel people can get from working with a financial advisor? Inevitably, some people will manage on their own. But
yeah. I mean, I think there's a lot of value to working with financial advisors, as long as there's that good relationship. The fact that the advisor is actually there to help, particularly a lot of investors who do not understand how the investing system works, do not understand the complex tax system, whether it's planning for inheritance, whether it's planning for other financial instances, or got a lot of people coming into money and not knowing how the system works. Those are individuals and families that obviously can benefit hugely from advice. So, I mean, it can be a win-win. And in any industry, there's kind of good and bad. And, as you say, the central thing is trust, to find somebody who's good, to find somebody who's trustworthy, and work closely kind of with those people. Or if you're in the lucky position to be able to do it yourselves, whether through just directly yourself or through, an efficient manager or advisor, where you do part of it and they do part of it, that can be another beneficial solution. And the last thing I would say is, it's not just advisors, a lot of accountants can give good advice. So you don't necessarily have to go to a financial advisor. There are lots of good accountants who specialize in an area, and then you get a fee for that particular job.
Gina, your thoughts on the value of advice?
I think it's very important. As you say, we run a direct-to-consumer platform, but we have lots of clients who also work with advisors and lawyers and accountants, because it's about that partnership and relationship to ensure that collectively the client is better off and is getting the best possible outcome. And so, we need to work with them. But advice is so important, especially around tax and planning. And the earlier we can get people to do that, the better. But we do have an issue. We need to promote the profession as well, because we need a much more diversity when it comes to financial advisors. So there's a job of workers not just to educate and inform people, but also to diversify the workforce and ensure that we have people who look like the clients in our industry as well. So, there is some work to do there about the people we have who are the face of financial services and financial advice.
Gina and Alan Miller, thank you very much. So let's hear from the FCA again. This is what a spokesperson told me.
We're aware that firms of all sizes, particularly smaller firms, raise concerns about the length and complexity of our rules. We want to address areas of complexity, duplication or over-prescription which create regulatory costs with limited consumer benefit. We would welcome any solid evidence that firms are ignoring our rules.
And that's about it for this time. Thank you to our guests, Andy Agathangelou and Alan and Gina Miller, and to the FCA for responding. If you would like to respond to the FCA's consultation on consumer duty and financial regulation in the UK, the deadline is the 31st of October 2024. Just use the form on the FCA website, fca.org.uk, fca.org.uk. Remember, the financial industry will most definitely be having its say. As consumers, we also need to have ours. Until next time, goodbye.